What if I told you that building wealth isn't complicated? What if the reason you're not wealthy has nothing to do with your income, your education, or your background, and everything to do with the fact that the financial industry profits from your confusion? What if there's a simple, proven path to financial independence that Wall Street doesn't want you to know because it would put them out of business? Right now, financial advisors are charging you fees to actively manage your money, and statistically, they're underperforming a strategy so simple a child could execute it. Banks are earning interest on your money while paying you almost nothing. Credit card companies are extracting wealth from your future self to fund your present consumption. And everyone is making this seem so complicated that you're paralyzed, doing nothing, while your potential wealth evaporates. You're about to discover why complexity is the enemy of wealth, why the stock market isn't gambling when you understand one simple principle, why debt is stealing your future freedom, and the exact path to financial independence that requires no special knowledge, no stock-picking skills, and no financial advisor. This is the simple path to wealth. Let's walk it. Imagine you're lost in a forest. You need to get to the other side, where financial freedom and independence are waiting. You encounter a guide who tells you the path is incredibly complicated. You'll need detailed maps, specialized equipment, years of training, and constant course corrections. And by the way, I'll be your guide for a fee that compounds over decades and consumes a significant portion of your destination's rewards. So you hire the guide. You follow their complex strategies. You pay their fees. And after years of wandering, you discover something shocking. There was a simple, straight path through the forest the entire time. You could see it if you just looked up, but the guide kept your attention on the complicated ground-level details because their livelihood depended on you believing you needed them. This is the financial industry in a nutshell. They've convinced you that building wealth is complicated, that you need their expertise, that only professionals can navigate the markets. They've created an entire language designed to confuse you. Alpha, beta, expense ratios, loads, derivatives, hedge funds, actively managed portfolios. They profit from complexity. They die from simplicity. J.L. Collins wrote, "The simple path to wealth, to cut through all of that, to reveal the simple, proven, boring path to financial independence that anyone can follow. No special knowledge required, no complex strategies, no constant monitoring, just a simple system that, if followed consistently over time, virtually guarantees wealth building." The book originated from a series of letters Collins wrote to his daughter, explaining what he wished he'd known about money when he was younger. The tone is personal, clear, and refreshingly free of financial jargon. He's not selling you complicated products. He's not affiliated with financial institutions. He's just a guy who achieved financial independence through simple principles and wants to save you from the mistakes he made and sees others making constantly. The core message is radical in its simplicity. Spend less than you earn. Invest the difference in a simple stock index fund. Avoid debt and wait. That's it. That's the entire strategy. Everything else is details, nuance, and psychological preparation for staying the course when markets fluctuate. But if it's so simple, why isn't everyone wealthy? Because simple doesn't mean easy. The path is simple, but following it requires discipline that most people lack. It requires delaying gratification in a culture of instant consumption. It requires ignoring the constant noise of financial media, screaming about hot stocks and market timing. It requires believing in a boring, unsexy strategy while everyone around you is chasing excitement. And because the financial industry actively works against simplicity, they can't charge fees for telling you to buy one index fund and hold it forever. They need you to believe. You need their active management, their stock picks, their constant adjustments, their sophisticated strategies. Their business model depends on you thinking, this is complicated. Collins destroys that illusion. He shows you that the emperors of Wall Street are wearing no clothes, that actively managed funds underperform simple index funds about 80% of the time over long periods, that the fees you're paying for expertise are compounding against you, stealing hundreds of thousands of dollars of potential wealth over your lifetime, that you don't need them at all. The book is structured around core principles: understanding what wealth actually means, how to build it through index investing, how to preserve it, and how to navigate the psychological challenges that cause most people to sabotage themselves. It's written for his daughter, which means it's written for someone with no financial background. Clear, accessible, practical. What you're about to learn will probably make you angry. Angry at how much money you've wasted on fees. Angry at how much more complicated you've made this than it needed to be. Angry at a financial industry that's been extracting wealth from you while pretending to help you build it. Good. Use that anger as fuel to take control of your financial future. But you'll also feel relieved. Relieved that you don't need to become a financial expert. Relieved that you don't need to pick stocks or time markets. Relieved that the path forward is actually simple, even if it's not easy. Relieved that anyone, regardless of income level, can follow this path if they're willing to be disciplined. The subtitle captures the promise: your roadmap to financial independence and a rich, free life. Financial independence. The point where your investments generate enough income to cover your expenses, freeing you from the need to work. And a rich, free life. Not just wealthy in money, but wealthy in time, autonomy, and options. This isn't get rich quick. This is get rich slowly but surely. It's boring. It's unsexy. It works. And it's available to you right now, regardless of where you're starting from. The question is whether you're willing to follow a simple path that requires patience and discipline, or whether you'll keep searching for complicated shortcuts that lead nowhere. Let's explore the simple path. Chapter 1. Debt, the unacceptable burden. Before you can build wealth, you must eliminate what's destroying it. This chapter addresses the single biggest obstacle to financial independence for most people: debt. Collins doesn't mince words. Debt is a crushing burden that steals your future freedom to fund your present consumption. Every dollar you owe is a dollar working against you, compounding in reverse, making someone else wealthy while keeping you trapped. Debt is the opposite of wealth building. It's wealth destruction. The math is brutal. If you have credit card debt at 18% interest, you're paying 18% for the privilege of having spent money you didn't have. Meanwhile, the stock market historically returns about 10% annually. This means every dollar in credit card debt is costing you 28% in opportunity cost. The 18% you're paying plus the 10% you're not earning by investing that money instead. Let's make this concrete. If you have $10,000 in credit card debt at 18% interest and you're making minimum payments, you'll pay over $20,000 total and take over 20 years to pay it off. That same $10,000 invested in the stock market at 10% annual returns for 20 years becomes over $67,000. So that $10,000 debt doesn't just cost you $10,000. It costs you nearly $90,000 in total impact on your wealth. This is why Collins says debt is unacceptable, not inconvenient, not unfortunate. Unacceptable. If you're serious about building wealth, eliminating debt is not optional. It's the mandatory first step. The chapter distinguishes between different types of debt. Though Collins considers all debt problematic, credit card debt is the worst. High interest rates, no productive purpose, pure consumption. You bought things you couldn't afford, and now you're paying enormous interest for that mistake. This must be eliminated immediately, even before investing student loan debt is complicated. If it's enabling education that increases your earning capacity, it might be worth it. But too many people take on massive student debt for degrees that don't increase their earning potential, leaving them with a burden they'll carry for decades. Collins advises extreme caution here. Only borrow what's absolutely necessary. Choose schools based on value, not prestige. And consider whether college is even the right path versus trade schools or alternative education. Car loans are usually unnecessary. Americans have been convinced that car payments are just a fact of life. Everyone has a car payment, right? Wrong. Wealthy people often drive used cars paid for in cash. Poor people drive new cars they can't afford with loans that keep them poor. A car is a depreciating asset. Borrowing money to buy a depreciating asset is financial insanity. Buy used cars with cash. Drive them until they die. Repeat. Mortgages are the one debt Collins views differently. They can be acceptable because they're typically low interest rates secured by an appreciating asset. You need somewhere to live, and buying can be better than renting in many situations. But even here, he advises caution. Buy less house than you can afford, put down as much as possible, and pay it off as quickly as possible. Don't view your home as an investment. View it as a place to live that happens to hold value. The chapter addresses the psychological addiction to debt. We live in a culture that normalizes debt, car payments, credit card balances. Buy now, pay later, 0% financing for 24 months. These are all marketing schemes designed to separate you from your money by making debt seem painless and normal. But debt is never painless. It's a constant weight. It limits your options. It forces you to keep working jobs you might hate because you need the income to service debt. It prevents you from taking risks or opportunities because you're locked into payment obligations. It steals your freedom, which is the whole point of building wealth in the first place. Collins shares his own experience with debt and the freedom he felt when he finally eliminated it. No payments, no obligations. Every dollar he earned was his to keep or invest. That freedom is priceless. But most people never experience it because they're perpetually in debt. The chapter provides a debt elimination strategy. First, stop adding new debt immediately. Cut up credit cards if necessary. No more borrowing, period. Second, list all debts with their interest rates. Third, make minimum payments on everything except the highest interest debt. Fourth, Attack that highest interest debt with every extra dollar you can find. Side hustles, spending cuts, anything. Fifth, once that debt is eliminated, take everything you were paying toward it and apply it to the next highest interest debt. This is the debt snowball like avalanche method, and it works. How do you find extra money to pay down debt? Spending cuts. Most people have no idea where their money goes. Track every dollar for 1 month. You'll be shocked at how much you waste on convenience, entertainment, and consumption you don't actually value. Cut ruthlessly. Every dollar you free up is a dollar attacking debt, getting you closer to freedom. Side income. Sell things you don't need. Take on extra work temporarily. Drive for Uber, freelance, do whatever it takes. This is temporary pain for permanent freedom. The intensity you apply to debt elimination determines how quickly you escape the trap. Collins emphasizes that you cannot build wealth while carrying debt. You might think you can invest while making minimum debt payments, but the math doesn't support that. If your debt costs 18% and your investments earn 10%, you're losing 8% by investing instead of paying debt. Pay the debt first. Then invest with the full force of your income. The chapter ends with this truth. Debt is voluntarily accepting slavery. You're trading your future freedom for present consumption. Every payment you make is money flowing away from you, enriching lenders while impoverishing you. The simple path to wealth begins with rejecting this trap entirely. Eliminate debt, stay out of debt, live debt-free forever. That's the foundation. Everything else builds on Chapter 2, the power of FU money. Once you understand that debt is the enemy, the next question is, what's the goal? This chapter defines financial independence and why it's worth pursuing with intensity. Collins introduces the concept he calls FU money. Enough wealth that you can say FU to anything or anyone that doesn't serve you. Bad boss. FU, I quit. Job that drains your soul. FU, I'm out. Toxic relationship. FU, I can support myself. Opportunity to pursue a passion that doesn't pay well? Yes, because I have FU money that covers my expenses. This isn't about being rude. It's about power and freedom. When you don't need the money, you have all the power in every negotiation. Employers know they can exploit people who desperately need the paycheck. They can't exploit people with FU money. Those people can walk away, which means they must be treated well or they'll leave. Financial independence is the point where your investments generate enough passive income to cover your living expenses indefinitely. You don't need to work anymore. You work because you want to, not because you must. This changes everything about how you experience work and life. The math is straightforward. If your annual expenses are $40,000 and your investments generate 4% returns annually, a conservative estimate, you need $1 million invested to be financially independent. The investment generates $40,000 per year, covering your expenses, allowing you to live indefinitely without working. But here's the beautiful part. You probably don't need as much as you think. The biggest variable is your expenses, not your income. If you reduce your annual expenses from $40,000 to $30,000, you only need $750,000 invested. If you reduce to $25,000, very doable in low cost of living areas, you only need $625,000. This is why frugality is so powerful. Every dollar you cut from your expenses has a double benefit. You need less total wealth to be financially independent. And you free up more money to invest toward that goal. A person earning $50,000 and spending $30,000 will reach financial independence faster than someone earning $100,000 and spending $90,000. Even though the high earner makes twice as much, Collins shares his own path to financial independence, working corporate jobs he didn't love, living well below his means, investing the difference consistently, and eventually reaching the point where work became optional. That optionality changed how he experienced work. He became more selective, more willing to take risks, more empowered to speak up because he didn't need the job. The chapter addresses common objections. But I could never live on $25,000 per year. Maybe not in San Francisco or New York, but there are beautiful, safe, interesting places in the U.S. and around the world where $25,000 per year is a comfortable lifestyle. Financial independence doesn't mean you have to live in expensive cities. It might mean you choose not to, but what about unexpected expenses? You build a buffer. Your 4% withdrawal rate is conservative. Historically, portfolios can sustain even higher withdrawal rates. And you maintain flexibility. If markets are down, you reduce spending that year. If you want more security, target a larger nest egg that generates more than you need. But what if I want to enjoy life now, not just save for the future? This is the key question. Financial independence isn't about deprivation. It's about conscious choice. You spend on what genuinely brings you joy and cut ruthlessly on what doesn't. Most people spend money on things they don't value out of habit, social pressure, or unconsciousness. When you get intentional, you often discover you can have what you truly want for far less than you're currently spending. The chapter introduces the concept of enough. Our culture constantly pushes more income, more possessions, more consumption. But at some point, more doesn't increase happiness or satisfaction. It just creates complexity and maintenance burden. Financial independence requires defining enough for you, not what society says, not what your neighbors have, but what genuinely satisfies you. For Collins, enough was less than he expected. He discovered that the lifestyle he actually wanted cost far less than the lifestyle he thought he was supposed to want. This realization accelerated his path to financial independence because he wasn't chasing an inflated target. The chapter explores what you do after achieving financial independence. Contrary to popular belief, most people don't stop working entirely. They shift to work. They find meaningful even if it doesn't pay well. They volunteer, they create, they learn, they contribute. The point isn't to be idle. It's to be free to choose how you spend your time based on meaning rather than money. Collins shares stories of people who reached financial independence and the transformations that followed. The corporate executive who quit to teach in underfunded schools, the consultant who started a nonprofit, the engineer who became an artist. None of these paths would have been possible without FU money enabling the transition. The psychological benefits are profound. Financial independence removes the constant low-level anxiety about money that most people carry. It removes the pressure to keep up with others. It removes the fear of job loss or economic downturns. You're positioned to weather any storm. This peace of mind is priceless. The chapter ends with this insight. FU money isn't about saying FU to everything. It's about having the option. Most people with financial independence are actually more gracious, more generous, and more collaborative than before because they're operating from abundance rather than scarcity. But knowing you can walk away from anything toxic changes how you experience everything. That's the power. That's worth pursuing with intensity. Chapter 3. The Index Fund, your wealth-building tool. Now we arrive at the core of Colin's strategy, the tool that will build your wealth, not stock picking, not active trading, not cryptocurrency. A simple, boring index fund. Collins explains what an index fund is. A fund that owns a tiny piece of every company in a particular market index. The most important for most investors is a total stock market index fund, which owns a piece of every publicly traded company in the United States. When you buy shares of this fund, you're buying a piece of the entire U.S. economy. Why is this powerful? Because you're betting on the overall growth of the economy rather than trying to pick individual winners and losers. Over the long term, economies grow. Companies create value. Productivity increases. Innovation happens. All of this translates to stock market growth. The S&P 500, top 500 U.S. companies, has returned about 10% annually over the past century, including boom periods and crashes. This means if you invest in a total stock market index fund and hold it for decades, you capture the growth of the entire economy. You don't need to pick the next Apple or Amazon. You automatically own them as they rise. You also own companies that fail, but the winners dramatically outweigh the losers over time, resulting in net positive returns. The beauty is simplicity. One fund, that's it. You don't need to research individual stocks. You don't need to read financial statements or predict market trends. You don't need to do anything except buy and hold. The index fund automatically adjusts as companies enter and exit the market, always holding a representative slice of the economy. Collins compares this to active investing, trying to pick individual stocks, or using actively managed funds, where professional managers select stocks they think will outperform. The data is devastating for active investing. Over 10 to 20-year periods, roughly 80 to 90% of actively managed funds underperform simple index funds. The professionals, with all their education, research, and experience, can't beat the simple strategy of buying everything. Why? Partly because markets are efficient. Publicly available information is quickly incorporated into stock prices, making it very hard to consistently identify undervalued stocks. Partly because active management involves costs, trading fees, research expenses, managers' salaries, all of which come out of your returns. And partly because human psychology creates predictable mistakes, overconfidence, herd mentality, panic selling, greedy buying. Index funds avoid all these problems. No stock picking means no human error in selection. Minimal trading means minimal costs. Just automatic, passive participation in market growth. It's boring. It works. Collins recommends Vanguard specifically, and particularly their Total Stock Market Index Fund, VTSAX, or equivalent Y Vanguard, because they're structured as a mutual company owned by their fund investors, meaning they have no external shareholders to profit. This allows them to offer the lowest expense ratios in the industry, the fees you pay to own the fund. Expense ratios matter enormously over time. If you invest $10,000 per year for 40 years with a 10% return, and 0.04% expense ratio, Vanguard's typical rate, you'll end up with about $4.8 million. The same investment with a 1% expense ratio, typical for actively managed funds, leaves you with about $3.7 million. That 0.96% difference in fees cost you over $1 million in final wealth. The fees compound against you, stealing wealth that should be yours. This is how the financial industry has been robbing you. They charge seemingly small percentages, 1%, 1.5%, 2%, that compound over decades into hundreds of thousands or millions of dollars extracted from your potential wealth, and they deliver worse performance than a simple index fund you could manage yourself. Collins walks through the practical steps of investing in an index fund. Open a Vanguard account or equivalent low-cost provider. Choose a total stock market index fund. Set up automatic investments. Every paycheck, a portion automatically goes into the fund. Then do nothing. Just let it sit and compound. Don't check it constantly. Don't panic when markets drop. Don't try to time the market. Just hold. The chapter addresses the question of international investing. Collins is somewhat flexible here. You can own just U.S. stocks, his preference, or add international stocks through an international index fund. The U.S. market is already heavily international. U.S. companies earn significant revenue overseas, but adding international exposure can provide additional diversification. The key is keeping it simple. One U.S. fund and maybe one international fund. That's it. What about bonds? Collins addresses this later, but the short version, stocks for growth, bonds for stability. When you're young and accumulating wealth, you want maximum growth, which means 100% stocks. As you approach and enter retirement, you might add bonds to reduce volatility, creating a mix like 75% stocks / 25% bonds, or 60/40. But while building wealth, stocks are where you want to be. The chapter ends with this powerful insight. You don't need to be smart to build wealth with index investing. You just need to be patient and disciplined. The strategy is so simple that complication is the only thing that can derail you. Don't overcomplicate it. Don't think you need to add sophisticated strategies. Just buy the index fund, hold forever, add more money regularly, and let time and compound growth do the work. Chapter 4. The market always goes up, eventually. Understanding the index fund strategy is one thing. Having the psychological strength to stick with it when markets crash is another. This chapter prepares you for volatility and why it doesn't matter. Collins makes a critical point. The market will crash. Not maybe. Not if you're unlucky, definitely. Markets crash regularly. Every few years, there's a significant downturn. Every decade or so, there's a major crash. This is not a bug. It's a feature of how markets work. Accepting this as normal and expected is essential for success. Since 1929, there have been 25-plus market crashes of 20% or more. The Great Depression, Black Monday in 1987, the dot-com crash in 2000 to 2002, the financial crisis in 2008 to 2009, the COVID crash in 2020. If you've been investing for any length of time, you've experienced crashes. If you're starting now, you will experience crashes guaranteed. Here's what else is guaranteed. The market has recovered from every single one. After every crash, the market eventually reached new highs. Sometimes it took months, sometimes years, but it always recovered because the fundamental engine, economic growth, human innovation, productivity, continues despite temporary setbacks. This is the key psychological truth. Short-term volatility is irrelevant if you're a long-term investor. If you're 30 years old investing for retirement at 65, you have 35 years. The market will crash multiple times during those 35 years. It will also grow substantially. What matters is the overall trajectory, not the temporary dips. Think of it like this. If you're driving from New York to Los Angeles, you don't panic every time the road goes downhill. You understand that roads have hills, up and down, but the overall direction is westward toward your destination. Stock markets work the same way up and down constantly, but the long-term trend is up. Collins shares historical data that proves this. If you had invested $10,000 in the S&P 500 in 1975 and held until 2015, you'd have over $1 million, despite multiple crashes during that period. If you panicked and sold during crashes, or tried to time the market by buying and selling, you'd have dramatically less. The buy and hold investors always win over time. But here's where most people fail. They can't emotionally handle the crashes. They watch their $100,000 portfolio drop to $70,000 in a crash. It feels like losing $30,000. Panic sets in. Financial media is screaming about the end of the world. Everyone around them is selling. So they sell too, cutting their losses. Then what happens? The market recovers, but they're not invested anymore. They're sitting in cash, having locked in real losses by selling low. They wait for things to calm down before buying back in. By the time they feel comfortable, the market has recovered significantly. They buy back at higher prices than they sold at. They've just bought high and sold low, the opposite of the successful strategy. This pattern, panic selling during crashes and cautious buying during recoveries, destroys more wealth than crashes themselves. Crashes are temporary and recover. Panic selling creates permanent losses. This is why psychology is more important than strategy for investment success. Collins provides rules for surviving crashes. First, expect them. They're coming. They're normal. They're temporary. When a crash happens, your reaction should be, "Oh, another crash. How predictable," not, "Oh no, this time is different." Second, do not sell. Every cell in your body will scream to sell and stop the bleeding. Ignore that instinct. It's wrong. Selling during crashes locks in losses that would otherwise be temporary. Holding means you get to participate in the inevitable recovery. Third, ideally, buy more. Crashes are sales. Everything is cheaper. If you're still accumulating wealth, crashes are gifts. You get to buy index fund shares at discount prices. When markets recover, those discounted shares appreciate just like the shares you bought at higher prices, but you paid less for them. Crashes make patient investors wealthier. Fourth, zoom out. Don't check your portfolio daily during crashes. Daily volatility will make you crazy. Check annually, or even less if you can stand it. The more you check, the more likely you are to panic. If you're decades away from needing the money, short-term values are irrelevant. The chapter addresses the inevitable question, but what if this time is different? What if the market doesn't recover from this crash? Collins' answer, It's never different. Every major crash in history has been accompanied by this exact sentiment. During the Great Depression, people thought capitalism was over. During the 2008 financial crisis, people thought the entire system was collapsing. Every time, they were wrong. The system adapted and recovered. Could there be a crash so severe that markets never recover? Theoretically, yes, if civilization collapses or something equally apocalyptic. But if that happens, your investment portfolio is the least of your concerns. You'll have bigger problems, like survival. And in that scenario, what was the alternative? Keeping money in cash that's also worthless? At least with stocks. You own pieces of companies with real assets. Collins also addresses sequence of returns risk. The fact that crashes hurt more if they happen right before or early in retirement, when you're withdrawing money from your portfolio. This is a real concern, which is why he recommends moving some allocation to bonds as you approach retirement, providing stability. But even this is manageable with planning. Maintaining several years of expenses in bonds or cash so you can avoid selling stocks during temporary downturns. The chapter ends with this truth. Successful investing is more about behavior than knowledge. The strategy is simple. Buy index funds and hold forever. The challenge is having the psychological fortitude to stick with it when markets crash and everyone around you is panicking. If you can master your emotions, stay the course, and ignore the noise, the market will make you wealthy over time. If you can't, you'll be another statistic of panic selling and market timing that destroys wealth. Your choice. Chapter 5. The Withdrawal Phase. Building wealth is one challenge. Living off that wealth in retirement without running out of money is another. This chapter addresses how to sustainably withdraw from your investments once you've reached financial independence. Collins introduces the 4% rule, a guideline that says you can withdraw 4% of your portfolio value annually, adjusted for inflation each year, with a very high probability of not running out of money over a 30-year retirement. This rule comes from comprehensive historical analysis, showing that 4% withdrawal rates would have survived virtually every historical period, including starting retirement right before major crashes. Here's how it works. If you have $1 million invested, you withdraw $40,000 in year 1, 4% of $1 million. In year 2, you withdraw $40,000 adjusted for inflation. If inflation was 3%, you withdraw $41,200. Year 3, you adjust again for inflation. You're not recalculating 4% of your current portfolio value. You're taking your initial withdrawal amount and adjusting it annually for inflation, regardless of what markets do. This approach has historically worked, even when markets crashed early in retirement, the worst-case scenario for sequence of returns. Why? Because the portfolio continues growing even as you withdraw and eventually recovers from crashes. Over 30 years, the combination of investment growth and your withdrawals balances out, leaving you with assets remaining even at the end. But Collins adds important nuances. The 4% rule is a guideline, not a law. In reality, retirees should be flexible. If markets crash significantly and your portfolio drops 30 to 40%, you might reduce your withdrawal that year to allow faster recovery. If markets are booming and your portfolio is growing beyond what you need, you might increase withdrawals to actually enjoy your wealth. The key is monitoring and adjusting rigid adherence to 4%, regardless of circumstances, can cause problems. Flexibility, spending less in down years, spending more in up years, improves sustainability and allows you to actually enjoy the wealth you've built. The chapter addresses asset allocation in retirement. While building wealth, Collins recommends 100% stocks for maximum growth. But in retirement, when you're withdrawing money, 100% stocks creates too much volatility. A major crash early in retirement, combined with withdrawals, can damage your portfolio's sustainability. Collins recommends shifting to a stock-bond mix as you approach and enter retirement. Maybe 75% stocks / 25% bonds, or 60/40, depending on your risk tolerance and spending needs. Bonds provide stability. They don't crash like stocks, and they generate income. This stability allows you to withdraw from bonds during stock market crashes, leaving your stocks untouched to recover. The strategy: keep several years of spending in bonds or cash. When markets are up, withdraw from stocks and replenish your bond / cash reserves. When markets crash, withdraw from bonds / cash and leave stocks alone to recover. This prevents the disastrous scenario of being forced to sell stocks during crashes to fund spending. Collins also addresses Social Security. For Americans, Social Security provides a base income in retirement, reducing how much you need to withdraw from investments. If Social Security covers $30,000 of your $50,000 annual spending, you only need to withdraw $20,000 from investments, which means you need less total wealth to retire comfortably. But don't count on Social Security fully. The system faces long-term funding challenges. It probably won't disappear entirely, but benefits might be reduced. Plan as if you'll get something, but don't make it essential to your retirement plan. The chapter explores different retirement scenarios. Early retirement, before traditional retirement age, requires more wealth because your money needs to last longer. Retiring at 40 means potentially 50+ years of life to fund, not 30. This requires either more conservative withdrawal rates, maybe 3 to 3.5% instead of 4%, or willingness to do some income-generating work if needed. Traditional retirement at 65 works well with the 4% rule. You have Social Security starting soon. Your timeline is shorter. The standard approach works beautifully for most people. Late retirement, working into your 70s, allows more aggressive wealth accumulation and potentially higher withdrawal rates because your timeline is shorter. Some people choose this because they love their work or want maximum financial security. Collins shares his personal approach. He doesn't follow a rigid 4% rule. He pays attention to markets and spending needs, adjusting flexibly. Some years he withdraws more, some years less. This flexibility, combined with a conservatively sized portfolio relative to spending, gives him confidence he'll never run out of money. The chapter addresses one more critical point: estate planning. Do you want to leave an inheritance, or are you planning to die with zero? This affects your withdrawal strategy. If you want to leave money to heirs or charities, you'll withdraw more conservatively, ensuring wealth remains. If you plan to die with zero, you might withdraw more aggressively, enjoying your wealth fully during your lifetime. Collins leans toward the die with zero philosophy. He'd rather enjoy his wealth and leave less to heirs than die with millions unused. But this is personal. Some people find meaning in leaving legacies. Neither approach is wrong. The chapter ends with this insight. The withdrawal phase requires the same discipline as the accumulation phase, just applied differently. During accumulation, discipline means consistent saving and investing. During withdrawal, discipline means not overspending in good times or panic selling in bad times. Master both, and you've mastered the simple path to wealth from beginning to end. Chapter 6. Keeping it simple. The simple path works, but most people are tempted to complicate it. This chapter addresses the siren songs that lure investors away from simplicity and why you should resist them all. Collins begins with a fundamental truth. The financial industry profits from complexity. If investing is simple, buy an index fund and hold. There's no role for financial advisors, no commissions on stock trades, no fees for active management, no revenue from sophisticated products. The entire industry's business model requires you to believe investing is complicated and you need their expertise. So they create complexity. They invent products, hedge funds, structured notes, annuities, managed futures, option strategies. They promote active trading. Buy this stock, sell that one, time the market, rotate sectors. They sell fear. You need protection, insurance, hedging strategies. They sell greed. Get rich faster with this sophisticated approach. All of it is designed to extract fees from you while delivering worse results than the simple strategy of buying and holding index funds. Collins goes through common complexity traps and why to avoid them. First, individual stock picking. Many people are tempted to pick stocks, thinking they can identify the next Amazon and get rich quick. The reality, even professional stock pickers rarely beat index funds over time. You're competing against millions of intelligent, educated, full-time investors with far more resources than you. The odds of consistently picking winners are minimal, and even if you pick some winners, you'll also pick losers. Maybe you bought Apple at the right time, but you also bought Enron or Lehman Brothers. The winners need to outweigh the losers by enough to beat the index after accounting for all the time you spent researching, the stress of volatility in individual stocks, and the opportunity cost of your time. Almost nobody succeeds at this long term. Collins's advice: resist the temptation entirely. Individual stock picking is gambling dressed up as investing. If you must scratch that itch, limit it to 5 to 10% of your portfolio, money you can afford to lose, and keep 90% in index funds. But his real advice? Don't do it at all. Second, actively managed mutual funds. These are funds where professional managers actively select stocks they believe will outperform. They charge higher fees, typically 1 to 2% annually, for this expertise. The problem: 80 to 90% of them underperform simple index funds over 10 to 20-year periods. You're paying more to get worse results. The financial industry hides this through clever marketing. They'll show you the funds that did outperform. Our top-performing fund returned 15% last year. What they won't tell you is that their other 20 funds underperformed, and there's no way to predict in advance which funds will be the winners. Past performance doesn't predict future results, but they sell funds based on past performance anyway. Collins's advice: avoid actively managed funds entirely. They're expensive, they underperform, and they serve no purpose that index funds don't serve better. Third, market timing. This is the temptation to sell before crashes and buy before recoveries, maximizing gains and avoiding losses. It sounds logical. The problem? It's impossible to execute consistently. You need to be right twice. Right about when to sell and right about when to buy back in. Miss either timing and you underperform buy and hold. Studies show that market timing investors dramatically underperform buy and hold investors. Why? Because the best market days often happen right after the worst days. If you sold during a crash to protect yourself, you often miss the recovery days. Missing just the 10 best days over a 20-year period can cut your returns in half. Collins's advice: don't try to time the market. You'll fail. Everyone fails. Just hold through volatility and trust the long-term upward trend. Fourth, real estate investing. Many people are drawn to real estate, thinking it's safer than stocks or that they can get rich through property. Real estate can build wealth, but it's far more complicated than index investing. You need to find properties, manage tenants, handle maintenance, deal with vacancies, understand local markets, manage significant leverage, mortgages, and handle illiquidity. You can't quickly sell property if you need cash. Collins isn't anti-real estate. He owns property, but he's clear that it's not simpler or better than index investing for most people. If you love real estate and are willing to put in the work, fine. But don't choose real estate thinking it's easier or safer than stocks. It's neither. Fifth, gold, cryptocurrency, and alternative investments. Every era has its hot alternative investment. In the past, it was gold. Now, it's cryptocurrency. The pitch is always the same. Traditional investments are risky. You need this alternative for protection or massive gains. Collins is skeptical of all of them. Gold doesn't produce anything. It just sits there. Its value is based purely on what others will pay for it, which is speculation, not investing. Cryptocurrency is even more speculative, with wild volatility and uncertain long-term value. His advice: if you want some gold or crypto as a small hedge, 5% of portfolio maximum, fine. But don't make it a core holding. Productive assets, stocks in companies that create value, are where long-term wealth comes from. The chapter addresses the psychological drivers of complexity. We're attracted to complexity because it makes us feel smart and active. Buying an index fund and doing nothing feels too simple, too passive. We want to believe we're adding value through sophisticated strategies, but in investing, sophisticated usually means expensive and underperforming. There's also the narrative fallacy. We want investing to be an exciting story with dramatic moves and brilliant insights. Index investing is boring. There's no story to tell. But boring wins. Exciting loses. Collins emphasizes that the simple path requires confidence to follow when everyone around you is doing something more complicated. Your brother-in-law is day trading and bragging about his wins while hiding his losses. Your friend is buying rental properties. Your colleague is invested in a hedge fund. You're just buying VTSAX every month, like a boring person. But 20 years later, you'll almost certainly be wealthier than all of them, with far less stress and time invested. The simple path wins not because it's exciting, but because it's low cost, tax efficient, and captures market returns without the friction of complexity. The chapter ends with this challenge: resist every temptation to complicate your investment strategy. Every new product, every hot tip, every sophisticated strategy, say no to all of it. Keep it relentlessly simple. Buy index funds, Hold forever. Add more money regularly. Ignore everything else. That's the path to wealth. Everything else is a distraction designed to extract fees from you while delivering inferior results. Chapter 7. Taxes and Fees, the Silent Wealth Killers. You can follow the simple path perfectly and still undermine your wealth building if you don't understand taxes and fees. This chapter reveals how these silent killers compound against you and how to minimize them. Collins begins with fees, which we've touched on, but deserve deeper examination. The financial industry has mastered the art of extracting fees in ways most investors don't notice or understand. These fees compound against you over decades, stealing wealth that should be yours. Expense ratios are the annual fees charged by mutual funds and ETFs. They're expressed as percentages: 0.04% for Vanguard index funds, 1 to 2% for actively managed funds. These seem small, but they compound dramatically. A 1% expense ratio doesn't mean you pay 1% once. It means you pay 1% every year on an ever-growing balance. For decades, the example Collins uses: $100,000 invested for 30 years at 10% returns with a 0.04% expense ratio grows to about $1.6 million. The same investment with a 1% expense ratio grows to about $1.2 million. That seemingly small difference in fees cost you $400,000 over 30 years. If you're investing larger amounts, the difference is even more dramatic. This is why Collins obsesses over expense ratios and recommends Vanguard's index funds specifically. They have the lowest expense ratios in the industry, typically 0.03 to 0.05%. Every fraction of a percent you save in fees is wealth that stays in your account, compounding for you instead of being extracted by fund companies. Trading fees are another wealth killer. Every time you buy or sell investments, there's typically a fee, though this is becoming less common with modern brokerages. More importantly, frequent trading creates tax consequences and often leads to buying high and selling low. The data is clear. The more frequently investors trade, the worse their returns. The best investors are the ones who trade least. Advisory fees are particularly insidious. Many financial advisors charge 1 to 2% of assets under management annually. For a $500,000 portfolio, that's $5,000 to $10,000 per year. Over 30 years, that's $150,000 to $300,000 in fees paid to the advisor, wealth extracted from you for advice you probably don't need. Collins is blunt. For simple index fund investing, you don't need a financial advisor. The strategy is so straightforward that paying someone to implement it is wasting money. If you have complex estate planning needs or unique circumstances, a fee-only advisor who charges hourly rather than percentage of assets might be worthwhile for specific advice. But ongoing advisory fees for basic investing are unnecessary. Load fees are sales commissions charged when you buy certain mutual funds. Front-end loads charge you a percentage when you invest, typically 3 to 5%, meaning you start immediately down. Back-end loads charge when you sell. No-load funds charge nothing. Collins' advice: only buy no-load funds. There's no reason to pay sales commissions when equivalent no-load options exist. Now, we turn to taxes, which require more strategic thinking. Different account types have different tax treatments, and choosing correctly can save enormous amounts of money over time. Tax-advantaged accounts come in several flavors: traditional 4, 401ks and IRAs allow pre-tax contributions, reducing your taxable income now, with taxes paid on withdrawals in retirement. Roth 401ks and IRAs use after-tax contributions but allow tax-free withdrawals in retirement. HSAs, health savings accounts, allow pre-tax contributions, tax-free growth, and tax-free withdrawals for medical expenses. The basic strategy: maximize tax-advantaged accounts before investing in taxable accounts. For most people, this means contributing enough to your 401k to get any employer match. That's free money. Maxing out a Roth IRA, $6,500 to $7,500 annually, depending on age. Then returning to max out your 401k, $22,500 to $30,000 annually, depending on age. HSAs should be maxed if you're eligible. $4,150 for individuals, $8,300 for families. Only after you've maxed out tax advantage space should you invest in taxable brokerage accounts. The tax advantages are simply too valuable to pass up. Traditional versus Roth is a common question. Collins's general rule: traditional accounts are better if you expect to be in a lower tax bracket in retirement than you are now. True for most people, your income drops when you stop working. Roth accounts are better if you expect higher tax brackets in retirement. Maybe you're young and early in your career with low current income. Or if you value the flexibility of tax-free withdrawals. For those with access to both, a mix can be strategic. Traditional accounts give you a tax break now. Roth accounts give you tax-free income later. Having both provides flexibility in retirement to manage your tax bracket by choosing which accounts to withdraw from. Tax loss harvesting is an advanced strategy for taxable accounts. When investments in taxable accounts decline in value, you can sell them, realizing the loss for tax purposes, and immediately buy something similar, maintaining your market exposure while creating a tax deduction. This is valuable but requires careful execution to avoid wash sale rules. For most people following the simple path, it's not essential. Just stay the course in tax-advantaged accounts and don't worry about it. Capital gains taxes apply to taxable accounts when you sell investments at a profit. Long-term capital gains on assets held over 1 year are taxed at preferential rates, 0%, 15%, or 20% depending on income. Short-term gains, assets held less than a year, are taxed as ordinary income at higher rates. This is another reason to avoid frequent trading. You're triggering higher taxes. Index funds are tax efficient because they rarely sell holdings, generating minimal capital gains distributions. Actively managed funds constantly trade, creating tax bills for shareholders. Even if two funds have identical returns, the index fund will leave you with more after-tax wealth because it's not constantly triggering taxable events. The chapter addresses required minimum distributions, RMDs, from traditional retirement accounts. After age 73, as of 2024, you must withdraw a minimum percentage annually, whether you need the money or not, and pay taxes on it. This can be problematic if you have large traditional accounts. You're forced to take large taxable withdrawals. Planning around this, Roth conversions in early retirement, for example, can be valuable for large portfolios. Collins emphasizes that while taxes are important, they shouldn't drive all your decisions. Some people get so focused on minimizing taxes that they make poor investment decisions. The priority order is: 1. Invest consistently. 2. in low-cost index funds. 3. Using tax-advantaged accounts when possible. Don't let tax concerns prevent you from investing or cause you to make complicated moves that introduce other risks. The chapter ends with this summary. Fees and taxes are controllable factors that dramatically impact your wealth. Minimize them ruthlessly. Use low-cost index funds. Vanguard. Avoid advisors unless you have genuinely complex needs. Maximize tax-advantaged accounts. Hold investments long-term. These simple steps will save you hundreds of thousands or millions of dollars over your investing lifetime. Wealth that stays with you instead of being extracted by the financial industry or government. Chapter 8. The Simple Path in Action. The final chapter brings everything together into a comprehensive action plan you can start implementing today, regardless of your current financial situation. Collins presents the simple path as a series of steps. Everyone starts at different points, but the destination is the same: financial independence. Here's how to walk the path from wherever you are. Step 1. Build your emergency fund. Before investing anything, you need 3 to 6 months of expenses in a high-yield savings account. This protects you from being forced to sell investments at bad times to cover emergencies. Life happens: job losses, medical issues, car repairs. Having cash reserves means you handle these without derailing your investment plan. Some people object that keeping cash loses money to inflation. True, but that's not the point. Emergency funds aren't for growth. They're for stability and peace of mind. Once you have adequate reserves, everything else can be invested for growth. Step 2. Eliminate all debt except mortgage. As discussed earlier, debt is wealth destruction. Pay off credit cards, car loans, student loans, all of it. Only mortgage debt, which is typically low interest and secured by appreciating assets, is acceptable to carry. Everything else must go before you can seriously build wealth. If you have both debt and no emergency fund, which comes first? Collins says build a small emergency fund first, $1,000 to $2,000. Then attack debt aggressively. Then complete your full emergency fund. This prevents the common cycle of paying down debt, then hitting an emergency and taking on more debt. Step 3. Max out tax-advantaged retirement accounts. Once you have emergency reserves and no consumer debt, maximize contributions to 401ks, IRAs, and HSAs. For most people, this means contribute enough to 401k to get full employer match. Max out Roth IRA $6,500 to $7,500 annually. Max out HSA, if eligible, $4,150 to $8,300 annually. Return to 401k and max it out, $22,500 to $30,000 annually. This gives you $30,000 to $40,000 plus annual investment capacity in tax-advantaged space. For many people, maxing these accounts is sufficient to reach financial independence over time. Step 4. If you've maxed out tax-advantaged space and still have money to invest, open a taxable brokerage account and continue buying index funds there. This is a good problem. It means you're saving an enormous percentage of your income. The tax-advantaged space is still better, but taxable investing beats not investing at all. Step 5. Hold your investments forever. This is where most people fail. They follow steps 1 to 4, build a nice portfolio, and then panic and sell during the next crash, or they get bored and start trading, or they chase performance by switching funds. All of this destroys wealth. Your job is simple. Buy index funds and never sell them until retirement. Add more money regularly. Ignore market fluctuations. Ignore financial media. Ignore hot stock tips. Just hold and add for decades. That's it. The chapter addresses how long this takes. The formula is straightforward. The percentage of income you save determines how long until financial independence. If you save 10% of income, you'll need 35 to 40 years to reach FI. Save 20%, and it's 25 to 30 years. Save 50%, and it's 12 to 15 years. Save 70%, and it's 8 to 10 years. This is why frugality is so powerful. It has double impact. Lower spending means you need less wealth to be FI, and it means you have more money to invest toward that goal. Someone earning $100,000 and spending $50,000 will reach FI dramatically faster than someone earning $200,000 and spending $180,000. Despite the higher earner making twice as much, Collins shares his own numbers as an example. He didn't start investing seriously until his mid-20s. He saved aggressively, 50% or more of his income, and invested it all in index funds. He reached financial independence in his late 40s, not because he earned a massive salary, but because he saved a high percentage and let compound growth do the work. The chapter addresses common life stages and how to apply the simple path. In your 20s, you have time as your greatest advantage. Even small amounts invested now will grow into substantial wealth by retirement. Max out retirement accounts if possible. If money is tight, at least contribute enough to get employer match and max out a Roth IRA. Stay out of debt, live frugally. Build the habits that will serve you for life. In your 30s, you're likely earning more now. Increase retirement contributions aggressively. If you have children, fund retirement before college savings. You can borrow for college, but not for retirement. Resist lifestyle inflation. As income grows, keep living on what you lived on in your 20s and invest the increases. In your 40s, peak earning years for many people. This is when you can make serious progress toward FI if you're disciplined. Max out all retirement accounts. Pay off your mortgage aggressively if you have one. Start thinking about what FI looks like for you. When do you want to reach it, and what lifestyle will you live? In your 50s, I might be within reach if you've been following the path. Continue maximizing contributions. Start thinking about asset allocation as you approach retirement. Maybe shifting from 100% stocks to 75-25 or 70-30 stocks bonds for stability. Don't make drastic changes, but gradually add some bond exposure. In your 60s and beyond, if you followed the path, you're likely FI or close to it. Now it's about transitioning to withdrawal phase, managing your asset allocation for income and stability, and enjoying the freedom you've built. The chapter addresses what to do if you're starting late. If you're 50 and haven't saved anything, is it too late? No, but it requires intensity. You have 15 years until traditional retirement age. If you can save 30 to 50% of income and invest aggressively, you can still build substantial wealth. It won't be as much as if you'd started at 25, but it can be enough for a comfortable retirement, especially if you're willing to live modestly. Collins emphasizes that the simple path works at any starting point, whether you're 20 with nothing or 50 with nothing, the path is the same. Eliminate debt, build emergency reserves, invest in index funds, hold forever. The timeline varies based on when you start and how much you save, but the path doesn't change. The chapter addresses staying motivated over the decades this takes. Financial independence isn't achieved overnight. It's a marathon requiring consistent effort over years or decades. How do you stay motivated? First, track your progress, watch your net worth grow. Celebrate milestones, $100,000 net worth, $250,000, $500,000, $1 million. Each milestone is meaningful progress and deserves recognition. Second, visualize your FI life. What will you do when work is optional? What freedom will you have? Keep that vision alive. When saving feels like sacrifice, remember what you're building toward. Third, find community. Surround yourself with people on similar paths. Online communities like the Financial Independence subreddit provide support, encouragement, and accountability. Don't try to do this alone while everyone around you is spending everything. Fourth, celebrate the journey, not just the destination. Financial independence is valuable, but so is the process of gaining control over your money, reducing stress, and building confidence in your financial future. These benefits start immediately, not just when you hit your FI number. The chapter ends with Colin's final message. The simple path to wealth is simple, but not easy. Simple means the strategy is straightforward. Anyone can understand and follow it. Not easy means it requires discipline, patience, and psychological fortitude that most people lack. You'll be tempted to complicate it. You'll be tempted to panic and sell during crashes. You'll be tempted to spend instead of save. You'll be tempted to keep up with neighbors who are going into debt to finance lifestyles they can't afford. Resist all of these temptations. Follow the simple path with discipline. Spend less than you earn. Invest the difference in index funds. Hold forever. Stay out of debt. Ignore the noise. Be patient. That's it. Do this consistently for years or decades, and wealth is virtually guaranteed, not because of luck or market timing or sophisticated strategies, but because you're harnessing the fundamental power of compound growth over time. The path is laid out before you. It's not hidden or complicated. Millions have walked it successfully. The only question is, will you? Your future financial freedom depends on the choice you make today, and that's it. The simple path to wealth, the complete roadmap to financial independence. Let's crystallize the core truth you now understand. Building wealth is not complicated. It's simple. Spend less than you earn. Invest the difference in a low-cost total stock market index fund. Hold forever. Stay out of debt. Be patient. That's the entire strategy. But here's why most people who hear this will stay broke. Simple doesn't mean easy. The strategy is simple, but executing it for decades requires discipline that most people simply don't have. It requires saying no to consumption that everyone around you is saying yes to. It requires staying calm and holding when markets crash and everyone is panicking. It requires trusting a boring strategy when exciting alternatives are everywhere. You now understand that the financial industry has been lying to you. They've told you that investing is complicated, that you need their expertise, that you should pay them fees to actively manage your money. The data proves they're wrong. 80 to 90% of actively managed funds underperform simple index funds over time. They're charging you fees to deliver worse results than doing nothing. You understand that debt is not normal, not necessary, and not acceptable. It's a crushing burden that steals your future freedom to fund present consumption. Every dollar you owe is compounding against you, destroying wealth instead of building it. Eliminating debt isn't optional if you're serious about financial independence. It's the mandatory first step. You understand that the stock market isn't gambling when you buy everything and hold forever. Yes, markets crash regularly, and yes, they recover from every crash. Short-term volatility is irrelevant if you're a long-term investor. The people who fail are the ones who panic and sell during crashes, locking in losses that would have been temporary. You understand the power of compound growth over time. Small amounts invested consistently for decades become substantial wealth, not through magic, but through math. Time is your greatest advantage when you're young, but even if you're starting late, the simple path still works. You just need more intensity and focus. You understand that fees and taxes are silent wealth killers that compound against you over decades. Every percentage point you pay in fees or unnecessary taxes is wealth extracted from your future. Minimizing these ruthlessly through low-cost index funds and tax-advantaged accounts will save you hundreds of thousands or millions over your lifetime. You understand that financial independence isn't some impossible dream reserved for the wealthy. It's a mathematical outcome of consistently spending less than you earn and investing the difference. The timeline varies based on your savings rate, but the destination is achievable for anyone willing to be disciplined. But here's where 95% of people who learn this information will fail. They won't act. They'll watch this video, feel inspired, think that makes sense, maybe even buy the book, and then they'll do absolutely nothing. They'll return to their consumer lifestyle on Monday. They'll keep their money in actively managed funds, charging high fees. They'll keep carrying credit card debt. And in 20 years, they'll still be nowhere near financial independence, wondering why. Or they'll try for 6 months. They'll start investing, feel good about themselves, then hit the next market dip. They'll see their account value drop 15% and panic. They'll sell, protecting themselves from further losses. They'll sit in cash, miss the recovery, and buy back in at higher prices. They'll have bought high and sold low, destroying wealth through panic, and then decide, investing doesn't work for me. Don't be that person. You now have knowledge that will transform your financial future if you use it. The simple path is proven. Millions have followed it successfully. It works, but it only works if you actually implement it with discipline and patience. So, here's your action step, and it must happen today. Open a Vanguard account, or if you already have one, log in. Buy shares of VTSAX or the equivalent total stock market index fund. Set up automatic monthly investments. Then commit out loud to yourself that you will not sell these shares for at least 10 years, regardless of what markets do. Write that commitment down. Put it somewhere you'll see it when panic tempts you to sell. That's it. That's the first step. Not reading another book, not researching more strategies, not waiting for the right time to invest. Action. Today. Right now. Because here's the truth. You already have enough information. What you lack is action. And here's the harder truth. This will require sacrifice. You'll sacrifice consumption that your peers are enjoying. You'll sacrifice the new car, for a used one. You'll sacrifice the bigger house for a modest one. You'll sacrifice restaurants and entertainment to increase your savings rate. Your friends might not understand. Your family might question your choices. Society will call you cheap or weird. Let them. You're not building wealth for their approval. You're building it for your freedom. And when you reach financial independence in your 40s or 50s, while they're still grinding away at jobs they hate, wondering when they can retire, you'll be the one who's free. You'll be the one with options. You'll be the one who followed the simple path while they chased complexity and consumption. 5 years from now, you'll arrive somewhere financially. The question is where? If you keep your current pattern, spending everything you earn, staying in debt, avoiding investing because markets are too risky, you know exactly where you'll be. Probably not much different than today. Maybe deeper in debt. Maybe more stressed. Definitely further from financial independence. Or you could be somewhere dramatically different. You could have eliminated debt, built a 6-figure investment portfolio, established the habits and discipline that make wealth building automatic. You could be years, or maybe just months away from financial independence, with freedom visible on the horizon. That's not fantasy. That's what following the simple path produces. The path is simple. Buy index funds. Hold forever. Stay out of debt. Save aggressively. Be patient. That's it. Nothing fancy, nothing complicated, nothing that requires special knowledge or connections. Just discipline and time. Anyone can do this. The question is, who will? If this video showed you a path to financial independence you didn't know existed, share it with someone trapped in consumer debt who needs to see this. Leave a comment with your current net worth and your FI goal. Make it public, make it real, and subscribe for more content that doesn't sell you comfortable lies, but delivers uncomfortable truths that actually change your life. The simple path to wealth is laid out before you. It's not hidden. It's not complicated. It's not reserved for the rich or educated. It's available to anyone willing to spend less than they earn and invest the difference with discipline. The only question remaining is, will you walk it? Your financially free future self is counting on your answer today. Choose wisely.